Hey everyone, welcome back to the channel. If you're planning to buy a home in 2025 or refinance your mortgage, then this video is just for you. Today we're going to break down everything you need to know about home loan interest rates in 2025, what's happening in the market, what experts predict, and, most importantly, how you can get the best possible rate for your situation. So, grab a coffee, hit that like button, and let's dive in. Quick recap of 2024 in context. Before we talk about what's ahead, let's quickly recap what happened last year and why it matters for 2025. 2024 was a transition year for the housing market and interest rates in general. If you remember, the previous couple of years were marked by a dramatic shift. We went from historically low mortgage rates during the pandemic, rates below 3% were not uncommon in 2020 and 2021, to a sharp increase in 2022 and 2023 as the Federal Reserve raised interest rates to fight inflation. This sudden spike pushed 30-year fixed mortgage rates well above 6% and, in some months, even close to 7% or higher, depending on your credit and the lender. For many buyers, this meant higher monthly payments and, in some cases, being priced out of the market entirely. In 2024, inflation finally started to cool off, not overnight, but gradually. The Fed paused rate hikes mid-year and signaled that they were willing to hold rates steady and watch how the economy reacted. For the housing market, this meant that mortgage rates didn't continue climbing, but they also didn't fall dramatically. Instead, they fluctuated slightly within a range, generally staying between 6% and 7% for a standard 30-year loan. For sellers, this created mixed feelings. Many homeowners with ultra-low pandemic-era rates chose not to sell because moving would mean taking on a higher rate. This limited housing supply in many cities, keeping home prices relatively high despite higher borrowing costs. This context is super important, because it shows that the mortgage market in 2025 is still heavily influenced by the after effects of rapid rate hikes and lingering affordability issues. So, understanding this helps us make sense of what might happen next. What's influencing rates in 2025? Now, let's talk about what's actually driving mortgage rates in 2025. This part is crucial, because once you know these factors, you'll have a clearer idea of why rates move and what to watch for during the year. Factor 1. The Federal Reserve's monetary policy. At the top of the list is the Federal Reserve. Although the Fed doesn't directly set mortgage rates, it does set the short-term federal funds rate, which influences how expensive it is for banks to borrow money. When the Fed raises this rate, borrowing generally gets more expensive across the board, for banks, businesses, credit cards, and yes, for home loans too. In late 2024, the Fed shifted from raising rates aggressively to holding steady. Many analysts think the Fed might start cutting rates slowly if inflation keeps declining and the economy doesn't overheat again. If this happens, we could see mortgage rates ease slightly, maybe dropping by half a percentage point or more over the year. But remember, if inflation flares up again, the Fed could reverse course and keep rates higher for longer, which would likely keep mortgage rates elevated. Factor 2. Inflation trends. Inflation is another big driver. When prices are rising quickly, lenders demand higher interest rates to compensate for the decreased purchasing power of future loan payments. If inflation stays stubborn, say, because of higher oil prices or global supply chain issues, then rates could stay sticky even if the Fed wants to lower them. Factor 3. Overall economic health. Mortgage rates also reflect how strong or weak the economy is. If the job market stays strong and consumer spending remains high, there's more pressure to keep rates higher to prevent overheating. However, if there's an economic slowdown, for example, if unemployment rises or consumer spending drops, then mortgage rates might decline as lenders compete harder for fewer qualified borrowers. Factor 4. Housing market specifics. Finally, local and regional factors matter too. Limited housing supply, local job growth, and demand for certain areas can slightly impact the rate you're offered, even if the national average is stable. So, in summary, keep an eye on the Fed's announcements, watch inflation reports, and follow the general health of the job market. These clues will help you anticipate whether rates might trend up or down in 2025. Expert predictions for 2025. Alright, now that we know the big picture factors, what are the actual predictions for 2025? Most housing economists and major lenders have released cautious but slightly optimistic forecasts. While no one has a crystal ball, here's the general consensus based on the latest data. 30-year fixed-rate mortgage. Experts expect rates to gradually decline as the year progresses, assuming inflation continues to cool and the Fed begins modest rate cuts. A reasonable range is 5.5% to 6.5% for the standard 30-year fixed mortgage. In the first half of 2025, rates may stick closer to the upper end of that range, around 6% to 6.5%, since the Fed tends to move slowly and markets take time to adjust. By the second half of the year, if economic data cooperates, we might see rates dip closer to the lower end, maybe even slightly below 5.5% if there's an unexpected economic slowdown or faster than expected inflation drop. 15-year fixed-rate mortgage. These tend to run about half a percentage point lower than the 30-year fixed rate. So you might see rates in the 5% to 6% range for 15-year loans. Adjustable rate mortgages, ARMs. ARMs often start with an even lower rate for the first few years. For borrowers who plan to move or refinance within 5 to 7 years, ARMs could offer an attractive short-term savings opportunity, but they come with more risk if rates don't drop later on. Key point. While most predictions lean towards slightly lower rates compared to 2024, the drop probably won't be dramatic. We're unlikely to return to the ultra-low rates seen during the pandemic, because those were driven by extraordinary circumstances, massive stimulus and emergency Fed actions. Fixed versus adjustable rates. Narador. Now, let's tackle a question many home buyers and refinancers have in 2025. Should you choose a fixed-rate mortgage or an adjustable-rate mortgage, an ARM? Let's break this down in plain English. Fixed-rate mortgages mean exactly what they sound like. Your interest rate stays the same for the entire term of the loan, whether that's 15, 20, or 30 years. Your monthly principal and interest payments never change, which gives you peace of mind and makes budgeting much easier. On the other hand, adjustable rate mortgages, ARMs, usually start with a lower rate for an initial period, commonly 5, 7, or 10 years, and then the rate adjusts at regular intervals based on market conditions. So, why would anyone pick an ARM? Simple, the starting rate is often significantly lower than a fixed-rate loan. In 2025, with rates hovering around 5.5% to 6.5% for fixed loans, some ARMs might start as low as 4.5% to 5%. That's real savings, especially in the early years. But here's the catch: after the initial period, the rate can adjust up or down, depending on market rates at that time. If rates don't drop as you hope, your payment could rise unexpectedly. So, which should you choose? If you plan to stay in your home for a long time and want stability, a fixed rate is usually the safest bet. If you know you'll move or refinance within a few years, maybe you're buying a starter home or expect a job change, an ARM might help you save money upfront. Always run the numbers and talk to a trusted mortgage advisor. Sometimes the risk of an ARM isn't worth the stress, especially if you're not sure where life will take you. How to get the best rate? Alright, now let's get practical. How can you get the best possible mortgage rate in 2025? Here are 5 proven tips to help you save thousands over the life of your loan. 1. Polish your credit score. Your credit score is one of the biggest factors lenders consider. Aim for a score of at least 740. Pay bills on time, reduce your credit card balances below 30% of your limits, and avoid taking on new debt before applying for your mortgage. Even a small bump in your score can shave off a good chunk of interest. 2. Boost your down payment. Putting more money down reduces your lender's risk, which often means a better rate for you. A 20% down payment is a common benchmark because it lets you avoid private mortgage insurance, PMI, but even bumping up from 5% to 10% can improve your rate offer. 3. Shop around. This step is crucial. Many buyers still make the mistake of accepting the first quote they get. Compare offers from banks, credit unions, mortgage brokers, and online lenders. Even a 0.25% difference can mean thousands saved over time. 4. Consider paying points. Buying discount points means paying some interest up front to lower your rate permanently. This can be a smart move if you plan to stay in the home long enough to recoup the upfront cost through lower payments. 5. Time your lock wisely. Interest rates can change daily. Once you find a good rate, talk with your lender about when to lock it in. Some lenders offer a float down option in case rates drop further before closing. Ask if that's available. Remember, you have more control than you might think. A little extra preparation can put you in a stronger position to negotiate the best deal. Is 2025 a good year to buy or refinance? Finally, let's answer the big question. Is 2025 a good year to buy a home or refinance your mortgage? Here's the honest truth. There's no perfect year, and waiting for the perfect rate can backfire if home prices keep rising or inventory remains tight. If you're financially ready, you have a stable income, a healthy emergency fund, and can comfortably handle the monthly payment, then 2025 could absolutely be a good time to buy. Rates are expected to be slightly lower than in 2024, and with some patience and smart shopping, you can find a deal that fits your budget. If you already own a home with a higher rate, refinancing might save you money, especially if you can reduce your rate by at least 1 percentage point and plan to stay in the home long enough to cover the closing costs. The key is to focus on what you can control: your finances, your budget, and your long-term goals. Don't get stuck trying to predict every market movement. Instead, make a plan that works for you today and gives you peace of mind for tomorrow. Alright, that wraps up our deep dive into home loan interest rates for 2025. I hope you found this helpful and feel a bit more confident about navigating the mortgage market this year. If you enjoyed this video, please give it a thumbs up, subscribe for more personal finance tips, and drop a comment below. Are you planning to buy or refinance in 2025? I'd love to hear your thoughts and questions. Thanks for watching. Don't forget to like and subscribe, and I'll see you in the next video.